I want to just run you through and I'm going to start adding this to our future Sunday nights or Saturday nights. Um, I just want to run you through this. So what I'm looking at here, uh, oops. So we'll start with we had Alcoa. Yeah. So these are all daily charts. And I'm using the Sniper simplified version on this. So that thick blue line is the RL10. So we would think of that as the price. And we're just showing the PSARs and the dragon as the little noise boundary all along. Now, the standard look is going to be, here's the 150-day Sniper frame, that outside one. Then this one is your 30-day frame. This is your 10-day frame, and that's your 5-day frame. So those are the things that we need for the Sniper, but it's useful to go back like 270 so you can see how all those things fit together. So what I'm going to do is run through the base camp or the boot camp symbols that I always am looking for daily trades, so you can just kind of get a feel for how these things are doing longer term. And I'm just going to notice things like this feels like a COTA 2 ready to go. And if it can get above 56, I can just put an alert here and just automatically buy it. So if I'm going to be strict about that and say buy it on a swing above 56 because it has cleared this resistance level, what that really means is that between 50, which is my current price, 50 to 56, I have a $6 region of tactical trading, which on 30-minute or 1 hour or 10-minute or 3-minute, whatever, I have about $6 or 10% of wiggle room to work with. And I like it because it has these rising lows. So that on shorter term, that $6 target is worthy of acknowledgement, particularly when I come over to Alcoa and I see that the intraday R10 is 30 cents. So if I've got a intraday MMRB, minimum manageable risk box, of 30 cents, and I'm working off a $6 region, what I really have is 18 little boxes of 30 cents that forms my play region. So if I could see something like a turning point and resume, it's sold off and I can use that as my risk. I still got lots of 30-cent boxes on the way up before it hits statistical resistance around 56. Now, if it breaks through 56, my next resistance is here to 64, so that's another $8. So if I think of this as leg 1 and leg 2, there's as much as $14 of upside just inside my 150-day look. And I would think there's a lot of resistance in here. But if it can break above 70, 72, now suddenly we're looking all the way back to the long-term normal when this was up around 96 back in the day prior to, back in the COVID. So that's the daily. Now, my brother notices that it's ready to go on the 9 days. So since I'm using TC2000 and we can, I'm just going to quickly zoom to a 9-day look. Now, when I look at this on the 9-day, I'm looking at the same time frame. This is the power of TC2000. So this is what the 5-day blue box, that's the 5-day. And here's my 10-day. And that's what 30-day box, and that's the 150-day box. So on this one, notice that we've got the RL10 above the baby dragon. So this is the RL10, and this is the little baby dragon. Now notice what happens whenever that happens. You get a move from here to here. That doesn't look like much, except that's a move from 45 to 60. To go from 45 to 60 is plus 15. $15 on for that's a 33% gain. That move, triggered by this, has a 30% embedded. And all of that is happening while the 9 period PSAR is still down. So this counter trend move, this 33%, is happening while we are respecting the tides. And so now notice what happened over here when the cross occurred. It didn't, this was a counter trend move because the trend now was up. See where the PSAR is? So that move was from 90 to 70. So from 90 to 70 was a minus 22% move. But when that breaks, now you got to move from 70 to 38, 70 to 38, call it 40. So minus $30, that's at minus 40%. So when we respect the market tides, we can still look to take counter trend moves. So here's on the 9-day, this may be all you need, by the way. The R10 crosses the baby dragon, confirms when it breaks the PSAR and leaves here's the dragon buffer zone. When that breaks, you get that move. Notice what happened here. Price comes up to the edge of the dragon and rejects. And once that thing resumes, look what happens. Bam. And then a second leg down. So here's where we are now. Price, after a long, long while, has come down and is now challenging the PSAR. The dragon has started to slope up. The R10 has sloped up. It has a higher low. The baby dragon is up, and it's ready to break out of the 30-day range. What's not to love? This thing, even if it just gets to the peak, is going to 58 from 50. So 50 to 58 is plus $8. $8 on 50 is a 16%. It's a 16% move just to here. And if that clears 58, look out above. So there's some reasons to care about the 9-day because it just simplifies life a lot. And you should know where your little crossing points are between the R10 and the baby dragon and respect those moves. Leg 1, it came back. All it did was came back and held support where it's supposed to, and it's starting that next leg up. And if it breaks out of this little parallelogram, and the reason it could is because it's changing. So once you get used to evaluating prices in this framework, I just spent 4 minutes doing that. If you do that 100 times, you'll see that move in about 3 seconds. You'll see the key PSAR flip, support, breakout, and go. You'll see that in 3 seconds. And then you can evaluate 50 symbols times 3 seconds in 2.5 minutes. Routinely. If you did that once a week and you spent, hey, just double that, 5 minutes. If you spent 5 minutes a week on the 9-day and just did a rapid evaluation and just identify which ones you might want to trigger on, and then spend 5 minutes like I just did on 5 symbols, that would cost you 5 symbols times 5 minutes plus your original 5 minutes 25 minutes. You could spend 30 minutes a week and improve your swing trading immensely, as long as you have a set of symbols that give you diversity, different sectors. You have some U.S. and you have some globals. You have some broad indexes and you have some narrowly defined sectors, and you have a handful of targets that correlate to the sectors and to the market that always give you something in the different parts of the curve. So you can end up doing portfolio sector target rotation in a standard way. And that's all I do. That's why these symbols that are on this stack, this what I call the boot camp, that's all these things are, is they give me diversification around the world, across markets, indexes, with key targets. I've got 3 metals in here: Alcoa, Cliff Natural Resources, and U.S. Steel. You could put more, but I only need 3 metals to have a representation of the metals, and I compare them to XLB, which is the basic materials. So I can look at SPY, I can compare it to XLB, and then XLB I can take a look at my 3 metals: Alcoa, Cliff, and U.S. Steel. I can also look at cut and wood as my lumber, as opposed to the materials. I can look at XLK, and then I can look at the semiconductors of Intel, NVIDIA, and Texas Instruments. You saw, by the way, STLD, Ken H is optimizing that even further by adding another steel company into the mix. That's how you build a logic chain. But what you want is one set of symbols, in my view, that on one page you can see what's going on. So if this is where Alcoa is on the 9-day, postured, ready for a nice little breakout, hey, what if you just did something like, hey, what's my, if my entry was here, and I just picked the bottom of the dragon. So enter at 50, with a stop at 42. That's an $8. That's a 15%, 16% buffer. If you pick the 5-day range or the spine of the dragon, you got a very manageable position, favorable reward to risk. So if that's where Alcoa is, what's Cliff looking like? Exactly the same posture, but notice that it is further from the PSAR flip than Alcoa is. So this is actually still kind of in the chop, but it has made the turn. It's just not as mature. If you think of this as a business cycle, Alcoa is a little higher on the curve of recovery than Cliff, because Alcoa is already breaking through its PSAR flip, whereas Cliff is still down here and has room to go. So if that's true, where is U.S. Steel? Notice U.S. Steel is already through. Here's where he flipped, and now notice, look how pronounced that little Kata 2 was. This was a beautiful entry right in here at the PSAR flip at 24, and it's at 27. That's already plus 10%, and it's 18 days north of the PSAR flip. Where's that going to go? To the top of the dragon, 32. PSAR flip, 37. So if I was to map these out, I would say U.S. Steel is doing better than Alcoa, which is doing better than Cliff. But all 3 of them have made the turn, and it's just that this is your leadership position. So you tell me which one of those you want to trade. Do you want the more conservative, he's already well in hand, or do you want the smaller cap guy that's earlier in the... That's a matter of personal risk management, right? What if I looked at STLD? Can we do that? Oh. He's already free and clear. STLD, if we're being honest, offered us the entry right here. And this rascal's already... We missed the $20 move. That's a 25% move, while the rest of the steel... So maybe you want more than 3. So maybe if you have the S&P, and then you have materials, and now you have the metals, and you have the 3 that I follow, Alcoa, Cliff, and U.S. Steel, there's reasons why that you might want to specialize in that and go STLD and Nucor Steel. And start looking at, hey, maybe you could specialize in those guys. I don't know. But I do the same thing with XLK and the semiconductors, SMH, and then the 3 semis. And you could add AMD and Applied Materials and a bunch of other semis, like Taiwan Semi. But what I'm looking at is getting S&P. I want some finance and materials and some energy and some tech, so that I can see which of the sectors are working. And then maybe I want, for the other side of it, I want the globals, in case maybe I should be on that side of the fence. But when the S&P is doing well, one of those 4 sectors is going to be massive, and then one of the companies inside is going to be massive. And how much do you need? There's a certain risk management and relaxation that comes from managing your exits. But this is the reason why you might want to decide to specialize, because you might have different intentions. So that's what I want to say about a relaxed approach of the 9-day. Hey, if the 9-day was your long term, guess what a short term might look like? A 3-day. So in the same way that we look at the RL10 and the RL30 in the regression lines, and we say fast and slow, you can look at 3-day charts and 9-day charts as fast and slow. And my brother mentions, look at STLD on a 3-day. Yeah, you're going to like this one a lot. It's so good we have to pull the... we actually have to pull the chart. Sorry. We have to pull the chart down. Do you think there's any resistance overhead in STLD? None. This is that well-run steel company. In the year 2020, 2 years ago, he's trading at 20, and today he's trading at 110. And he's cleared all of this and all of this and is breaking out. How much of that? How much of that do you want? So you see me doing a lot of work on the intraday stuff just because you can. I don't like carrying overnight risk. But you might really like that. This thing is at the all-time. There's the 5-day low, the 10-day low. Here's your 30-day look back. Here's your 10-day. And remember, this is on a 3-day. That thing breaks out and you put a $10 stop on it. Where's the risk? So I'm trying to make the argument here that your 3-day PSAR flips will often get you into some amazing moves. And even when they don't work heavily, the risk is low. So if you're in this little chop, you don't win much, you don't lose much. But you just keep taking them when they leave the station, and occasionally you get paid off massively. So 3-day, 9-day. All you need is the PSAR and your standard sniper lookbacks of 10-day, 30-day, 150-day. So now you can zoom in on those. Now if I zoom down to the 1-day, this feels like really, really easy. Are you kidding me? Do you know what that represents right there? On Friday? Dude, that is an express train with no reason. That's all-time high. Buy it at 110 with a $5 risk. Wake up in a year, see where you're at. Buy it with a $5 risk, trail with a $10 trail. And come back, wake up 3 months from now, see where you're at. So I want to go back to the idea of, if you've got a set of symbols that give you the world market, you have the US and the globals, you have sectors, you have targets inside your sectors. What you really have is a nice sample of the world, and then this can act as information to help you decide where you want to drill down. And then that can lead you to things like STLD, especially if you are using things like a scan of the S&P 500 for those sniper targets, which are using the 10-day, 30-day, and 150-day lookbacks to find things that are in extreme conditions. This was in an extreme condition. That's why it jumped up on the sniper screen. That's what fireworks looks like. It's at the top of the 10-day, top of the 30-day, top of the 150-day, and you have a large 5-day range fireworks. That's the fireworks pattern in the sniper. So, 3 seconds times 50 charts, call it 6 seconds. 6 seconds times 50 charts gives you 5 minutes. And then pick 5 where you spend 5 minutes on 5 charts for 25 minutes. That gives you 30 minutes per week. So let's see what 6 seconds feels like. I know there's a way to do that inside. I'm trying to remember. You can set, I think it's in the tools. Where you can have this thing cycle through. It'll cycle through these things at a time frequency that you want, so it'll show it for 6 seconds and flash. I'm just going to do it manually, but I want you to just notice how easily this goes. Now what I'm going to do is get a standard look. I'm going to go back about 270 days and just notice some things. Let's see, there's this one. And I'm going to expand it so that we get, yeah. I love Alcoa. Apple. This is a fence sitter because he's kind of right in the middle, ready to break up or down. And if this breaks, it gets back to here. It took 5 seconds. Arc Genomics. Support level, COTA 2. If it breaks out from here, Has to get above the 30 and then back to the 150. That's a value play. That's in good shape. Tradable. Arc Innovation, even better. A real tight range compression. That's solid support level. Those people are not going to leave. They remember Kathy Wood when she was right up here. These people are the people who will not sell. And occasionally they will buy. So there's a target of about 50 on that. That's your tactical trade. That's your strategic trade. Aussie dollar. Look how this beauty trades. Long-term secular moves. This is, strong dollar, weak dollar. That's why I say, yeah, the dollar could be much weaker. That upward move can get all the way up to here. Bitcoin. If you're not buying Bitcoin now, you don't understand what deep value looks like. That's the people who are never going to sell. Target 1, target 2, target 3, target 4. And you have not much risk. Cliff, beauty. Coinbase, also perfect. Kathy Wood loaded up the truck on this thing at this support level. You still got lots of urges to buy. This was the FTX scandal. That gives you a chance to buy Coinbase at a 90% sell. 90% off. And a reasonable target of 75. Why wouldn't you? Low risk. Lumber. Fence sitter. You should pay. Look at the. Oh, God. Guys, sometimes on these basic commodities, PSAR flips, you get all of that move. PSAR flip, crush. PSAR flip, crush. PSAR flip, PSAR flip. Pay attention to raw materials. This is the business cycle. It's already kind of fully valued. And it's wood is under pressure because the housing industry is slowing down. But that's what the easier money in retrospect looks like. But be cautious. Potential turning point. Although I like that, your upside target is here. SSC, COTA 2, COTA 2, COTA 2. That's why you love the COTA 2. The SSC is the first signal. COTA 2 is where you deliver. Keep going back to the well. Agriculture feels like dead money. I thought this inflation play would be more, but that's pretty stable. I believe this has a chance to go up because of winter and Russia-Ukraine. Russian wheat's not in the market. So I'm expecting that's a latent play. Commodity DBC cycles like oil. Diamonds, the strongest U.S. sector. Look at 1, 2, 3. It's already testing the previous peak, whereas the S&P, just compare this to tech. Tech is only halfway back up. Right? That's what we meant by tech was leading down, is it might be ready to resume leadership. Diamonds have already closed that gap to the previous peak. That was the safety of the staples and the conservative large caps. So this is a coiled spring ready to take the next leap. That's why, to me, if tech starts to move, it could become the leader that takes the S&P higher. But diamonds have already closed that gap. Do you see that difference? Check or hold? You've got to be able to see that difference. Yeah. Devon Energy, emerging markets. After a long slide, that's where that strength in the globals is coming from. Ethereum, I'm going to go load up the truck on this one. It's still in the second position. I'm playing for a return to 15, 10, and then 15. Where's the risk? No risk. You're buying ETHE at $7. I mean, it's at 7. I think it's going to go to 14 before it goes to 0. That's my bet. Mexico, on the other hand, is already benefiting from being not the U.S., but you can see how this chop at the top, how much more is there to go? So to me, that's if this fails, here's the targets down here. So I worry about that. Yeah, could it go? Yeah, it might. But I'm also aware that if I have positions, I've got to be concerned about bringing that harvest to market. I'm not going to let all that get away. Brazil, not as strong as Mexico. Robinhood, not as interesting as Coinbase. Intel. This is my swing trade on Intel. Collapsing dragon. Collapsing dragon. Collapsing dragon scratch. Collapsing dragon. Second position, third position cover. After that long slide, caught a 2. Cash. And I'm ready to break out again. Starting to get short at 47, finally covering around 25. But that's what a turning point looks like to me. First leg, get paid. Support, breakout, could go. And then each one of these things now becomes targets on the way up. That's why I'm paying attention to semis. That's why they're on my stack. Compare that to NVIDIA. NVIDIA's in better shape. And then Texas Instruments in the best shape of all. Back to the Russell. Now let's see. The Russell was stronger than the Qs, but not as strong as diamonds, which had already gotten back to their peak. So IWM, the Russell is, if DIA is the strongest, IWM's in the middle, and the Qs are lagging in terms of broad indexes. You know, the SPY is the daddy rabbit, but if you go conservative, tech, and small cap, right now it's conservative, small cap second position, tech in third position. Decide where you want to place your bets. Real estate. So I do this because it's out of phase with the markets. Here's my swing trades on IWR. That long run up, collapsing dragon, that was a surprise. I missed the second entry here. Rolls over, caught a 2. I missed the second entry here on the collapsing dragon, but got paid. Then I noticed, caught a 2. Collapsing dragon, second position, third position cover. Missed the caught a 2s, but I'll catch it here. You might want to take a snapshot of that screen. Lithium, Microsoft in reasonable shape. Compare Microsoft to Apple. Apple much more volatile and in a downtrend. Microsoft in an uptrend. So all other things being equal, what you like is the fact that you got the Kata 2s and Microsoft is leaving this behind and in an uptrend. Ken H. asked me, what would you do if you played tech but then noticed DIA surpass? Well, to me, the reason I have them all on the screen periodically is I look to see, is the market is the market making gains, and if it is it who's in the leadership position? If it's the conservative ones, then I'm going to be favoring things like XLP, McDonald's, Coke, Home Depot, that kind of stuff, as opposed to pure tech plays. But even if you just look at the difference between conservative Dow, Russell, and tech, you can get a very interesting, just that little quadrangle there. If you look at if you study SPY as the baseline and you say, let me see, conservative DIA, Russell small cap, and techs, that without even getting into the sectors, you can kind of see which of those has the juice. Now, you might add MDY in there, but it's already starting to get a little busy. But I like that. That's why I only just show those four: SPY, DIA, IWM, and the Qs. And then because I'm interested in tech anyway, I always just put XLK on there, because this leads you to things like Microsoft and Apple and Intel and Cisco, whereas this is going to lead you to things like biotechs and NVIDIA and things like that. So you can get the new growth tech, old school tech, and sometimes the tug of war between those gets interesting. And right now, XLK is winning compared to the Qs, because it's like the conservative members of the Dow that are tech are in XLK. Right? So you learn to get a feel for that over time. Let's see, marijuana. MSOS is in great shape right here. Ready to break above. This entire cluster is gone, and now the next targets are this range, up around 20. That's compelling. NVIDIA, let's see, the FANGs are in good shape. This is all those, that's Netflix, Facebook, and all that. There's the big broad index, Google and Alphabet. That's a COTA 2 ready to go. You could do a lot worse than just buying the FANGs if you believe in the Googles and Amazon. Google and Amazon is the leader in that one. Right? Clean energy. I love the clean energy because as a sector, it just swings so nicely. And it's still in early days at a support level, and that's your promise of 60. Trading it between 40 and 60, you can make money in the buying in this region, selling in that region, managing in between. Pure play. PayPal, low risk. Qs beginning to emerge. That's the beginning of leadership. There is your double bottom, COTA 2, ready to go. It's got to get through. Got to get through here, and then to here. That's what tech leadership begins to look like. You're getting it in earlier days, so just watch that one carefully. Rivian, the alternate to Tesla, it just hasn't failed, but you're still being able to buy it at a technical support level, but it's got to get above 40 to be interesting. It's almost dead money anymore. I just keep it on board because it's an alternative electric vehicle to Tesla. Simon Property, commercial real estate. This is looking better than IYR, and I like it because it has cleared that, and now this is in play. You're catching the next leg up. So again, about 6 seconds per. S&P. Now you can see why I've got the here's that extra layer of value before it gets to the top of the 150. That's the next leg up, and then it's free and clear. But this is crucial around 430. That's the upside. Diamonds are already there, remember. The S&P was lagging a little bit. Squarespace, good shape. And you're getting it on sale, but it's got to get above 74, but then 90's in play. That feels pretty good. Better than Coinbase. Treasuries. Oh, this is why I swing trade treasuries. Look at that beautiful, orderly progression. Collapsing dragon. Missed the second position. Missed the third position. Just took this one. Re-entered short. Covered. Missed the swing. But took the PSAR flip. Took the collapsing dragon. Took the collapsing dragon. Took the collapsing dragon. Covered. Now I'm into this thing from here. And now it's going to be interesting to see if it can get back to 120. That's why you should consider treasuries as a swing. Because my 401k has a treasuries position in it that I can't trade around inside it. I have to use this as a hedge against losses in that to balance it all out. And that way I can still keep the 401k free and clear. Tesla. Value. Boy, you're going to be happy 10 years from now if you'd bought it around here. Don't bet against Elon. Texas Instruments. The strongest of the semis. Uranium. It's an oscillator. I'm not trading it actively, but I'm just still trying to figure it out. Oil coming off its highs, but stabilizing around 65. Getting ready for the next leg up, it feels like to me. Here's the tight risk. XOP is stronger than oil. It's a little more speculative. Notice the decline in, this is VXX, the decline in volatility to astronomically quiet levels. Which tells you, remember, we're still in sideways. So you could put an alert order in to just buy it automatically at 17. If it moves from 1450 and hits 17, I'm buying it just because. Lumber. The easier money is done. This is all middle of the road. If it can break out, then 81, then 90. But that's leg one. That's leg two. Perfect critical state. Which way is it going to go? Don't know, but I'm going to follow price. That's why you want to find those turning points. Look at the turning points on the PSAR flips on these things. On the commodities. Oh, God, is that money. So we're getting really close to a turning point here. Almost, but not quite. It doesn't take much more for that to flip. If that flips, it's coming to here, here, and here, the survey says. Wheat and precious metals, fully valued. U.S. Steel has come out of the, with higher lows, has cleared, free and clear to here, and then here. Now the last set is the XL series. Well, this is biotech stable. But now I'm looking through the sector spiders. Materials, fully valued. Finance, strong leadership but ready to turn. Tech, only halfway up the stack, could be the new leader. Staples, already fully valued. That was leadership then. XLY is early days. That could be the new growth. And then XOP pulling back off its highs. So that's my argument for how to do swing reviews. And we'll start adding this, I think, to the Saturdays. We'll see how that goes. Okay? Just want to give you a quick look. In the future, I won't spend as much time in explanations, just more in observation. Okay? All right, that's everything we got for tonight. Take good care. See you tomorrow.